I was just wondering if you could give your opinion on Dave Ramsey's portfolio recommendation, which from what I understand is 100% stocks for everyone, made up of 25% growth, 25% growth in income, 25% aggressive growth, and 25% international. Thank you.
Steve wants my opinion on Dave Ramsey's portfolio recommendation. Well, if you have listened to Dave Ramsey for any period of time, you've heard him give this. He basically says put 25% in growth and income, 25% in growth, 25% in aggressive growth, and 25% in international. And then, of course, he's got some big chunk of his income in real estate. So he's just talking about the mutual funds here. So there's a few issues with this portfolio recommendation. The first one is nobody actually knows what it is, right? Growth and income is this category that's used by mutual fund companies to mean all kinds of different things. Sometimes it means large growth stocks. Sometimes it means large value stocks. Sometimes it means large blend stocks. Sometimes it means a balanced fund, with 25% bonds or maybe 75% bonds. So depending on what mutual fund company you go to, their growth and income fund may be dramatically different. So this isn't really like recommending an asset class. It's like recommending a type of mutual fund that, people used as a description back in the 90s. Nobody really uses this anymore. And so I think in general, what he's referring to when he talks about this is a large blend, large cap stocks. We're talking an S&P 500 index fund type fund. His next category is growth. If you pin him down on this, it seems like what he's talking about is mid-cap and large-cap growth stocks. So he's talking about putting that first 25%, this growth and income, into large blend or large value. The second 25% into mid-cap or large-cap growth stocks. The third category is aggressive growth, and this is really hard to pin him down on. Sometimes this means mid-cap stocks. Sometimes this means small-cap stocks. Sometimes this can mean emerging market stocks. And so it's really unclear exactly what asset allocation he's recommending here. But I think most of the time when I've heard him talk about it, he's talking about small cap stocks. So now we've got, a quarter of your portfolio in large value, a quarter in mid to large cap growth stocks, and a quarter in small cap growth stocks. Then the last quarter is international. Okay, that's a little more straightforward. At least, it's a broad category, but at least you know what it means. The problems with this asset allocation. Well, number one, it's 100% stocks. Right? Yes, that has the highest long-term expected return, but that's assuming you can tolerate the volatility of this portfolio. And the vast majority of investors cannot. You don't really know what your risk tolerance is until you've been through a big, nasty bear market. And that is a terrible time to find out that your tolerance is not as high as you thought it was. I've got 3 partners who basically sold all their stocks low in 2008. And it had a dramatic effect on the size of their nest eggs. It's really held them back in their financial lives. You are far better off having a less aggressive portfolio than you are having one that's just a little too aggressive for you. And so I'd encourage you to dial back the risk a little bit by adding some bonds to the portfolio, at least until you've been through a bear market and know how you behave in that bear market. The other problem with David Ramsey's recommendation here is that he's generally recommending actively managed mutual funds. And the data is pretty clear on this. Over the long run, you've only got about a 10% chance of choosing an actively managed mutual fund that beats an index fund, a low-cost index fund in that category, in that asset class. And if you multiply that by multiple asset classes in your portfolio, the likelihood of choosing winners is even lower. And the worst part about it is that when these funds beat the index funds, they usually don't beat them by very much. When they fail to beat the index funds, they often fail by a lot. And so there's a lot of risk trying to pick active mutual fund managers that are going to beat an index fund. And frankly, I don't even think it's worth the risk. I just buy index funds. Yes, I know that in a long time period, 5 or 10 or 15% of the funds are going to beat my index fund. But I don't have to try to guess which funds those are in advance. I don't have to monitor those funds over the years. And I can basically ensure that I get the market return. So that's what I've chosen to do. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.
My dad, your host, Dr. Dahle, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, So this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.